Hey, what's going on? My name is Anthony, also known as Lending Bent, and I'm giving you a daily update of what's going on and just not just the real estate market, but all the common topics or hot topics that are going on in the world right now that pertains to real estate or just everyday life within the real estate industry. So there's a lot of new things going on that's pretty interesting. There's a lot of things going on, especially with a new president into power and in place. He is changing and stirring up a lot of things, not just in my space, in the real estate space, but other spaces as well, that has a lot of people in uproar. It's going to be very interesting to see what is going to happen in these next coming months. One thing that I saw that is pretty interesting is the Department of Efficiency, and they are going through and cutting a lot of spending, which means that there's going to be a lot of savings. But the question is, with the amount of savings, I have a clear understanding that they are going to do their absolute best to pay down the deficit, pay down the debt that the US owns, but also what else are they going to do with the savings that they're accumulating right now? Would a lot of it go to the middle class or individuals to help with home ownership? Will rates come down? These are common questions that I commonly see with a lot of individuals that call me that are asking questions regarding obtaining a mortgage or purchasing real estate. So I'm going to go over a few things that I think is pretty important that are causing pretty good hot topics on the internet. So since Trump has took office, there's been a lot of changes going on right now. Um, One of the biggest things that a lot of people I see have questions about on the internet is the DOGE, the Department of Efficiency, which they're going through and pretty much doing a big internal audit of what's going on with the funds that have been paid out to certain groups and certain agencies, and seeing where the money's going and how they can save and cut back on certain things. Now, from my understanding, the whole purpose of this department is to not only just cut funding and see what money is being wastefully spent on things that are not in line with American people, but it's also they're also trying their absolute best to keep inflation down or get inflation down to a certain level so that across the board, the idea is to make sure things are more at a breathing level, right? And I think it's very important that this is going on, to see where funds are being spent, because a lot of this money that's being spent elsewhere could be used, and the possibility could be used for not only for programs for home ownership or funds to help people with down payment assistance or different opportunities to build and develop areas to provide more housing or affordable housing for individuals or families. So I do think this could be a good thing, but I would not know until months down the road or years down to see what happens with everything that's going on. So the biggest thing that I run into a lot of times when I am helping clients is down payment, right? Most of the times with down payment, a lot of people don't have the reserve or have the full amount of down payment. So there's different programs that they look into, or what I would look into to help them with the down payment. And it's these down payment assistance programs. A lot of these down payment assistance programs have different variables and certain criteria that you have to meet. So across the board, there are programs that offer assistance at 640 and higher with the credit score. So when we're looking at your credit score, we look at all three. So we look at your TransUnion, your Equifax, and Experian, and we go with the middle score. So let's, for example, say your score is a 600, a 650, and a 680. We would use the 650 as your middle score, and we would use that to qualify you across the board. So with the 650, we would look at the down payment assistance programs that would be able to help you based on your income, credit and reserve, and the type of house that you're purchasing. And we'll create a game plan around that. Now, let's say, for example, you have a 580, a 600, and a 610. Would use your middle score, which would be a 600. Now, that would stop you from getting the better tier down payment assistance programs, but we can still look into other programs that may help you, that you may qualify for with that credit score at a 6 and a 610 or a 600 at a 600. However, it's not going to be as beneficial as the programs with a 640, with a credit score of a 640. And with that being said, what happens is if you have a 600 and you're at that credit score, they put more limitations on what you qualify for. So let's say an average person has a good amount of debt. So let's say you have about $30,000 worth of debt. Your income is, let's say, $70,000 a year, and you have a 600 credit score. Now, with your debt to income, with the down payment assistance program at a 600 credit score, that program may now require you to have a debt to income lower than 40%. So if you don't have a debt to income lower than 40%, then you no longer qualify for that program. And it makes it extremely difficult for you to get that assistance from different counties, states, or federal level with the down payment assistance programs. So across the board, I always say make sure you have a 640 and higher, because the higher the credit score, the better. It gives you more flexibility to do what you need to do and get the best options available for you. So that's something that I always recommend. When you get these down payment assistance programs, there's really two different ways to obtain down payment assistance. They have a forgivable option and they have a payable option. So the forgivable, you would obtain it if you qualify for it. That loan would be forgiven, or that grant would be forgiven after a certain amount of years. The second option is the repayable. So within that option, there's two options within there. So they have one that's deferred, where you don't pay it right away or on a monthly basis, but later down the line, if you decide to refinance or sell your property, you have to pay that money back. The other option within that payment option of the down payment assistance program, they allow you to pay it back. And sometimes when you qualify for the one where you have to pay it back on a monthly basis within your mortgage, it's because you probably make too much money and they see that on paper you can afford it. So they're not going to grant you the forgivable program, but they would grant you the payable program. So you have to pay it back on a monthly till it's paid off for a certain amount of time. So it's always important to look at your different options to see what is the best option for you. A lot of the time, some people, it depends on the house. So if you are purchasing a house in a rural area, maybe you would be able to qualify for something called a USDA loan, which would allow you to qualify for 100% financing, but the property has to qualify for that loan. So it has to be considered a rural area. For example, if you are buying a property, let's say on South Beach, Florida, that's not going to qualify for a USDA loan. If you're buying a piece of property, let's say in Leesburg, Florida, you may qualify for that loan option, but we would have to check the address on the property and make sure you qualify for it. And there are requirements for that as well. But like I said, always make sure you have a 640 and higher, because it allows you to have more flexibility and different ways to look at different options. So it's very important to always work with a good loan officer where you can have those different options and see what's the best route for you and your family. And if you're a veteran, you have a variety of options where you can look at different properties. It doesn't matter if this property is in a certain area. You have that flexibility to use your VA benefits for a home purchase and see if you qualify for that home. And every case is different based on the veteran. So it's always important to get a good loan officer to sit down with you, form a game plan, see what's going to be best for you to put things together. So when you start the process of obtaining a loan, it's a lot easier, it's a lot smoother. It's easy to help you not be as stressed out during the process. So it's always important to make sure you have a game plan when you're doing these things, and work with a good loan officer. Want to go over some things that are going on in the space right now. There was an article that came out today, and I do want to talk about it because the current sitting president right now has pretty much had a discussion of the CFPB. And what the CFPB is, just to summarize things, they protect the consumer. They want to make sure that consumers are being taken care of when they go to institutions or financial institutions, and they're not being taken advantage of. So pretty much there's no fraud being done to the consumer or manipulation or any sort to take advantage of the consumer. The whole purpose of the department is to protect the consumer at all costs. And they go after financial institutions that are doing wrong by consumers. So it is a very important agency to have. But as we've learned, there are some things that they've been spending money on that, you know, hasn't has been pretty interesting. So the sitting president has mentioned um, making some changes to the CFPB, seeing what could be done to save money or cut funding or cut a lot of funding going to the CFPB on a year-to-year basis. So pretty much what the CFPB does, it implies and enforces a range of consumer financial laws such as the Fair Credit Reporting Act, which, among other things, help ensure the accuracy and privacy of people's credit reports. So they always make sure their whole job and their whole purpose of that agency is to protect the consumer. That's what they're there for, is to protect the consumer. They came into play roughly right around the Great Recession, and the whole purpose of them is to make sure that things like that don't happen again. So predatory lending, stuff like that, don't happen again. Does predatory lending still happen to this day? Yes. Are they as aggressive as they were before at a large scale with financial institutions? No. But there are smaller investors, smaller institutions that are still predatory lending to individuals. There was a recent article not too long ago. It was a pawn shop where a lady took pretty much a loan from the pawn shop, and it was a crazy amount of interest rate. It was a crazy interest rate, and she was paying all this money, and it was going to take her forever to pay it off. So the CFPB, they would technically step in that situation to make sure that these things are resolved and that nothing was fully, or the consumer wasn't fully taken advantage of in that situation. So they would be investigating that, or they're supposed to. So that's what the CFPB does. They just make sure that certain things, like a few examples when it comes to protecting the consumer, they want to make sure that consumers' loan balances and debts are actively being amortized, and the fees associated with that loan is very transparent. So there aren't invisible fees, junk fees, or unrealistic penalties with obtaining that loan, and certain fees that may cause the consumer to pay a lot of money or be in a rough situation. So they go in and make sure things are good at a financial standpoint, and financial institutions are following the consumer laws. So that's what the CFPB does. Now, with the sitting president, there has been talks of him saying that it's a thought of him getting rid of the CFPB. And my personal thoughts on it, I would like to assume that individuals would know, okay, during the Great Recession, these are things that happen. If you know the history of what happened back then, and you know, okay, we don't want to end up in that situation again. So logically, when we are obtaining a loan application of any sort, we want to make sure that the individual approves and can afford this loan. We don't want to just give people loans that they can't afford, and it gets out of hand, and it's a whole disaster that could happen again. So now, I would hope that individuals within the space would know, okay, let's logically think, let's not do this, because this can put not just individuals in a rough spot, but the whole country. If everybody has no limitation, they can give as many loans as possible, right? So the most important thing is, if this department is terminated or eliminating the agency as a whole, there has to be certain roles that are tied to a different agency or a different department to take care of the consumer, so that it doesn't scale to a level where it's out of control and causes a massive recession or out of control lending to everyday individuals. So that's just my personal thought. I do think that even if it is, if the agency is eliminated, that individuals still in the space should know these are rules that are put into play for a reason. So hopefully you consider that if it does get to the point. But I don't personally believe that it's going to get to the point where it's a free-for-all in the wild, wild west cowboy days back when the Great Recession happened. So I'm not too worried about that. I just think they're going to look at the spending and what the money is being allocated to and for, and try to minimize the amount of money that's going to that agency and use it for other things, or implement improvements within the agency to better protect consumers. So that's my personal thought. Hopefully I am right, but we will have to see in the next coming months.